Joining me now is Nancy Tengler, CEO, Laffer Tengler Investments. Nancy, great to have you back at the desk.
I know, Caroline. Thanks for having me.
We're very happy to have you. So Nancy, you have to say S&P 500 sitting near record highs right now after the tamer than expected, or basically inline inflation data this morning. You've actually said this is one of the best market tapes you've seen since the 1990s.
Yeah.
Why? What makes you so bullish from here?
And there's similarities, but there's also a lot of differences compared to the 90s. It is because of earnings, of course, but because we're in a technological revolution, call it an economy in transition, and the productivity-driven growth is compelling and will continue, and it'll feed on itself. And we're hearing it from the companies. We sit on all the earnings calls, and we're hearing across sector utilization of all the new technologies, not just AI, not just cloud computing, but physical AI, as well as power-driven kind of solutions. So we're pretty excited.
We'll dig into those drivers in just a second, but first, I think some investors might hear comparisons to the 1990s and get concerned because they'll think bubble. What makes this time period different than then?
Because the companies are real. You know, back then they had debt on their balance sheet and nothing else. Now you've got these companies that have pristine balance sheets, fortress balance sheets, really. Lots of earnings power, and I'm speaking of the hyperscalers as an example. But also in the 90s, from 95 to 2000, what you had was about 60% earnings growth, but 220% price appreciation in stocks. So it was a mismatch. Multiples were expanding to ridiculous levels, 100 times earnings for Cisco. And now what you're seeing is about 80% growth over the last 5 years and about 85 to 90% total return. So not multiple expansion, and that's a good way to see growth. Multiples are kind of high, but that's not a harbinger of a bear market. It's more about the mismatch that we had in the 90s.
But you'd say this is an expensive market here?
I'd say it's fairly valued because the growth is so powerful. So if you're in the interest rate environment we're in, which for younger investors feels like very high levels, but for those of us who've been doing this for a while, this looks pretty good, below the norm really for the 10-year over the last 40 years. So we're pretty excited about the opportunities, and therefore it doesn't feel stretched as a market.
You talk about earnings as being a driver. I think the big question, though, is what drives it from here. We had Carter Worth on yesterday. He's more of a charts guy. He isn't as bullish based on the charts, and basically pointed out that, we can say the S&P 500 is sitting at an all-time high right now, but over the past 3 months, it hasn't really gone a whole lot of anywhere. It's been flat. So what is it that really breaks us out of this tight range then?
I think a broadening of the underlying securities. I mean, we've had a pretty concentrated run that has been somewhat mitigated by the summer swoon, as we call it at Laffer Tengler. But I think you'll begin to see the broadening out. We've been shifting toward or expanding our exposure to infrastructure. So the AI infrastructure build, we owned many of the stocks. We've added new ones, and we've added to existing holdings. $7.5 trillion in CapEx spending for compute, power, and for data centers. And that's over the next 5 years, according to Goldman Sachs. So I want to be exposed to that. I think that's what's going to drive this, a shifting of sector leadership.
So when you say broadening, you're talking about a broadening within tech then?
Well,
I mean, we have been seeing an overall broadening, but as you think about the market leaders from here, is it still very tech-driven just on the infrastructure side?
I think it's the new technologies driven. So is Eaton a technology company? It's building infrastructure for the electrification of the new technologies. So that's what I mean by broadening out. It's
so
really
dig into those infrastructure plays. Aside from Eaton, what's the best way to invest in the infrastructure theme, if you will?
I think Quanta Services, now it's had a big run, but I think it can sustain that based on the backlog and the earnings growth expectations guided by management. We also own GE Vernova. That's the turbine company that's driving a lot of the power. We added to Williams recently. That's another name that it's a defensive way to play the AI trade, because remember, they're transmitting the natural gas and they have fixed fee contracts, so they have really very limited exposure to nat gas prices, and they're a workaround for the hyperscalers. So I think that's an interesting one. We also own things like Deere, which is an industrial that really has nothing to do with the infrastructure, but is utilizing AI to help farmers pick weeds and plant, and using automated tractors. Pretty cool. You can go in and have dinner, and your tractor can keep sowing seeds. So,
oh, interesting.
yeah.
So yeah, and it definitely a different way to play AI. I was taking a look at your notes though, and Amazon and Nvidia recently made it into your value portfolio. Yes. Talk to me about Amazon and Nvidia, the fact that they are value plays at this point, and do you still think that their value's right here?
Yeah, that's a good catch, Caroline, because most people miss it. We've owned them in growth. 2 years ago, we added Google to our value portfolio. If you remember, after Bard, everyone said they're never going to compete in AI. It was a disastrous launch. And then they came out with Gemini, and the stock's up over 100%. But if you look at the Russell 1000 Value Index, the world is upside down. The largest holding is Amazon. The first half of the year, it was Micron. So I don't know how they're I know how they're doing the calculations, but sometimes you get these fallen angel growth stocks that are trading like value stocks. With Nvidia, the big dividend increase was a wink from management, in our view, that they believe this earnings power is sustainable. It was also trading at a multiple of between 16 and 18 times next year's earnings, with earnings growth of 60 to 80%, depending on if you use the fiscal year or the calendar year. So we wanted to have a piece of that, because on a price earnings to growth ratio, it was trading at 0.25 times, whereas a stock like Tesla is trading at 5 times. So that was that stock. And then Amazon just couldn't get out of its own way. We really believe well, we believe Andy Jassy knows what he's doing, and he's been through this before with AWS, so we wanted to be in it before earnings. That's rare for us, and we got lucky. We sold some Apple to buy the Amazon, and it was a perfect trade for at least a couple weeks.
Would you still buy both here?
I would.
Okay.
Yeah, I would.
I should note that your strategies have all outperformed the S&P 500 so far this year. I was taking a look at the list. As you think about your highest conviction ideas for the rest of 2026, though, because some of these names have run up, what are those?
I do think it's in the infrastructure. So the names that I've already mentioned, there's some other names that we're looking at that we can't talk about because we're going to be adding them. But I think that will be the trade for the second half of the year. Now, that does not mean we need technology to also outperform for the market to do well. So I think you still want to own a number of the tech names, and the cybersecurity names are a big part of our portfolio. So Palo Alto Network and CrowdStrike, that business is going to grow, but there's also going to be competition from the vertically integrated AI names. So I think Palantir, ServiceNow, they're all getting into cyber or security for data, and I think that's going to be an interesting battle going forward.
Palantir is a name that you would add here?
We did add to it during the summer swoon.
But we've seen a rebound in Palantir. It's still down on the year, but it's quite a bit higher than it once was. So,
I mean, with these highly valued, I'm not going to say overvalued stocks like Palantir, Tesla, SpaceX, they're narrative names. So the growth at Palantir is remarkable, but you're buying that name for the future. So consequently, it's very volatile. During DeepSeek, we added, I just happen to remember this, we added to the name at $88 a share. It ran up to like $250, and then it came back down to $108. I'm still happy. So you just want to use volatility as your friend if you're a long-term investor, and that is what we do.
Your 6 top picks for 2026 are up more than 40%. Walmart, AMD, PWR, Quanta, Tesla, CrowdStrike, D.R. Horton, DHI. If an investor missed out on those, which one would you still definitely put fresh money into right now?
Of those 6? Well, it depends on your time horizon and your risk appetite. If you have a robust risk appetite, I would continue to add to CrowdStrike. If you don't, I think Walmart is getting interesting in here because it has underperformed Target for the first time in, I don't know, 5-6 years.
Yeah, by quite a bit.
Yeah, and they're expanding margins because they're using all the technologies.
Tesla is on that list. It's been the big laggard.
Yes.
What still needs to happen for Tesla to actually become the winner?
I think as well, I mean, full self-driving and really the cyber cab and robotaxi really need to launch. But that's the name we got into because of the battery storage business, the Megapack business, electric grade, utility grade battery storage. I think the potential merger with SpaceX or acquisition by SpaceX of Tesla will be a catalyst for price outperformance.
I have to ask, because at the top you were talking about why this time is different than the 1990s, and you talked about these pristine balance sheets, kind of the fortress balance sheets. SpaceX is obviously public now, doesn't necessarily have that pristine balance sheet yet. It's not a profitable company. Would you be an investor in SpaceX here?
Yeah, we just added some. We owned it on the IPO, and we have added to it recently on weakness. This is a name you're going to buy for the next 3 to 5 years. And honestly, in my view, Caroline, you're not going to care if you got it at 105 or 150, because it will be the future and will change the way we live. So the whole Elon Musk dynamic is you just have to hunker down during periods of weakness, because he will inevitably find a way. And there was a big article in the Journal yesterday about how he will win on his pay package if there is a merger acquisition, because he'll meet a bunch of the metrics. He's always about 2 steps ahead of everyone else, maybe even a dozen steps ahead.
What about some of the other sectors that we haven't hit on? Healthcare, energy, financials. Do you expect to continue to see a broadening out of this market overall, and where are you finding opportunities there?
So we in financials, for example, we own Goldman, we own Brookfield Asset Management, and JP Morgan. I mean, we own 1 or 2 others, but those are kind of the biggest holdings in the portfolio. What we're hearing from these companies is that they are utilizing AI. So Goldman talked about it on the call that they're going to keep headcount flat, but they're going to grow 25% faster. So that's a powerful multiplier. I would be looking at consumer discretionary. That's a sector that we're overweight. We like a number of the names we recently added to before earnings, thank goodness, Starbucks. That name is a really interesting one because the CEO, we knew he knew how to turn it around, and he is. Amazon, of course, is consumer discretion. I think Home Depot gets interesting here. We own it. It's in our 12 best ideas portfolio. Has not really done much, and that's the nature of the beast. But we think housing will ultimately see a renaissance. I'm just not sure when.
Anything you're avoiding here?
Staples. We own a couple. We own 1 utility, electric utility. REITs. I just think there's better places to be right now. We own a REIT or 2 in the portfolios, but not even a market weight. So I think when you're in a growth, a really super-sized growth environment like this, you want to stick with the growth.
I know you don't do price targets, but as you think about where the market goes from here, I would venture to guess you'll say higher. How much higher?
Well, I don't know. We're up about 10% this year on the S&P. I think we could close out. I would be happy if we closed out the year up 12 to 15% rather than 20 to 25, because what we know from previous bull markets, and this is a fairly young bull market, certainly compared to the 90s, but what we know is that you need to take a breather. You need to prune back the roses, knead down the dough, however you want to say it. You need for things to settle in. So I would be content there. We may get a real big momentum boost in the fourth quarter, which is usually when we see that.
A 15% breather is
pretty
still a pretty good breather.
Yeah.
What proves you wrong? What's the biggest risk to this bull market?
Yeah, I would have said geopolitical shock at the beginning of the year, but we've seemed to work our way through that, as we always do. I mean, if companies start missing, I think if we start to see guidance that is slowing, well, let me say this. We will see a deceleration in earnings growth. The question is how much. If the credit markets crack, I'll be wrong. I mean, credit spreads are still pretty tight by historical standards. You're hearing a lot of grousing from the bond market, too much debt, but this is nothing compared to what we've seen in the past. So I think those two things in particular.
Okay. I think this is a great time to pivot to our rapid fire round of this or that. You know how to play. Quick questions, quick answers, no hedging. Are you ready?
Yeah. No.
Right. Here we go, Nancy. Wall Street, too bullish or justified?
I think it's justified.
Stocks at record highs, buy or wait?
I think if you're a long-term investor, you buy. Sorry, I hedged.
It's okay. AI trade, early or late?
Early.
$10,000 today, lump sum or average in?
Lump sum.
Bigger mistake, chasing winners or sitting on the sidelines?
Sitting on the sidelines.
Biggest market risk from here, valuations or inflation?
Inflation.
Best place for fresh money, value or growth?
Growth.
Best value in the market today?
Stock.
Or sector?
I'd say consumer discretionary.
Top consumer discretionary pick right now?
Amazon.
More upside from here, Amazon or Apple?
Amazon.
Broadcom or AMD?
Broadcom.
Palo Alto or CrowdStrike?
CrowdStrike.
Mag 7 name you'd avoid here?
Meta.
Buy one, Tesla or SpaceX?
Tesla.
For the next 12 months, US stocks or international?
US.
Better bet from here, large caps or small caps?
I think large caps still.
For long-term investors, individual stocks or index funds?
Individual stocks.
Cash on the sidelines, put it to work now or wait for a pullback?
Put it to work.
One word to describe how you're feeling about the market for the rest of this year.
Bullish.
Market by year end, higher or lower?
Higher.
How much higher?
I'd say 5%.
Nancy Tengler, always appreciate you joining us. Thanks so much. That's Nancy Tengler, CEO of Laffer Tengler Investments. If you want to hear the opposite perspective, check out our full interview with Carter Worth. He explains why he'd be underweight tech right now and reveals which sectors he'd rotate into.